Okay, so everyone's asking, from the FT to pensioners, is AI in a bubble? Are stocks too expensive? I'm biased. I'm a bear. My career started just after 2008. I became an accountant instead of probably a banker or a trader because it was a really risk-off time. I'm also British. We don't have that American optimism. We're not as mercantile. But I will lay out now points for why, 3 points for why it's not in a bubble. AI stocks are not in a bubble. One, companies with the AI are more profitable with lower expense. So their productivity, staff productivity is higher, and their headcount, unfortunately, is lower. And two, Bill Gates says this is the most significant tech change in his whole life, more than the internet. Profound technological change that will change the way we interface with the world. Three, the S&P forward multiple at 23 is fair, even though the long-term average is 18. Why is it fair? Because the companies that make up a huge part of the S&P are super high-quality tech companies that have monopolies, that don't have cyclicality like the former oil super majors, for instance, or banks, which have such cyclicality based on interest rates. These are companies that have very low price sensitivity for their goods. They're companies that are investing huge amounts in AI and will lead the way in AI because they have huge amounts of money to invest in it. Okay, where am I more comfortable? I'm more comfortable saying, yes, of course it's a bubble. Why? One, everyone always says this time is different. It's never different. There's always a huge amount of excitement in human nature, and then disappointment and fear. And the real market price is somewhere in the middle. That's the long term. And there's always competition, which erodes away profitability. When a company is doing great, competitors come and erode that profitability. So long term, there is a reason why there's a long-term average of around 18 as a forward multiple for the S&P. And I believe it'll stay that way, or relatively close. I don't think we're in this regime change where 23 is a new normal S&P forward multiple. Two, Sam Wood. He's the head of research and strategy at Accumulus, and he does a great job of outlining the numbers, and JP Morgan have written about this recently, of just how much profitability needs to be made, how much profit needs to be earned in future to make sense of the current enormous AI capital expenditure. And he believes that companies aren't really taking into account the obsolescence of the huge investment they're making as well. AI is moving right now at such a high rate that there will be decay of current technology, which will be hugely expensive to the current investors. Just like the London Underground, being one of the earliest undergrounds, costs a fortune to fix and is all rickety on the older lines. It's the same with the early AI adopters. Three, a great idea, an example of a bubble, is Amazon Web Services' $38 billion deal with OpenAI. Guess how much the Amazon stock price went up as a result of that deal being announced? 100 billion. It's just not in line with the value that's being created. There's a huge amount of excitement because of the great potential of AI. But it doesn't mean that each of these stocks in themselves is worth as much more as as the market is telling us. Thank you for watching until the end. I want to hear where you disagree. Which points are weaker points? Which points I made are stronger points? Add some points. Please comment below. And please subscribe for more videos like this below.